Money supply, finding the right balance.
Bullseye!
Once upon a time, if you needed a loan, you would go to your local bank, which would issue you a bill of exchange, the grandfather of paper currency. Eventually, the total value of the bills of exchange issued by banks began to exceed the amount of gold they actually had in reserve. However, this wasn't necessarily a problem, since it was unlikely that everyone who had deposited gold with a given bank would demand to withdraw it at the same time. A similar system still exists today. When a bank grants a loan, it uses an accounting entry to create money that it doesn't physically have. This money then circulates in the real economy. Like if a family takes out a loan to buy a car or washing machine, for example. The sales of such goods boost the revenue of the companies that make them, and this revenue is used to pay employees' salaries. As borrowers pay back their loans, the money is taken out of circulation in the economy. Think of our economy as a huge auction house. If banks double the amount of loans they grant, then everyone has twice as much money to bid on the items being auctioned off, which means the final prices paid by bidders eventually double. This type of price increase, resulting from an increase in the money supply, is also known as inflation. If wages rise slower than inflation, then consumers can no longer buy as many goods. This in turn shrinks companies' revenue. Therefore, high inflation can dampen economic activity. On the other hand, if there is not enough money in circulation, if everyone has half as much money to spend, then prices fall, leading to what is known as deflation. In deflationary economies, consumers tend to put off non-essential purchases. Why buy something today when it will probably be cheaper a few months from now? As a result, companies tend to see shrinking margins, which also depresses economic activity. So, deflation, like high inflation, is bad for an economy. Therefore, it is crucial to carefully control the amount of money in circulation, or the money supply of an economy. This is what central banks do, by indirectly affecting the amount of loans granted by banks. Banks borrow money from a central bank at a set interest rate called the key interest rate. This rate then determines the rate at which banks lend out money to businesses and consumers. When interest rates are low, demand for loans increases and more money gets injected into the economy. When interest rates are high, demand for loans decreases and less money flows into the economy. Central banks update their key interest rate every month based on factors like inflation, in order to modulate the economy. Most economists agree that a target inflation rate of between 2 and 4% is ideal for keeping an economy running smoothly.